The moment you realize something is wrong with the financial system rarely comes with a warning bell. It usually arrives quietly, hidden behind headlines about interest rates, inflation numbers, currency fluctuations, or political tensions somewhere across the globe. At first glance, these stories appear disconnected, almost routine, the kind of background noise that markets absorb every day. But occasionally, the signals begin to align in a way that is impossible to ignore. A subtle tension starts building beneath the surface of the global economy, a pressure that grows slowly at first, and then all at once. And when that pressure finally releases, it can redefine markets, wealth, and financial security for an entire generation. Right now, we are living in one of those moments. Before you go any further, like this video, subscribe, and turn on notifications so you don't miss what's next. Drop a comment below telling me where you're watching from and the current time in your country. Now, let's get back to the topic. For years, the global monetary system has operated under the assumption that stability is the norm. Investors have been conditioned to believe that central banks can smooth out recessions, stabilize currencies, and maintain the steady growth that modern economies depend on. Whenever markets wobble, liquidity is injected. Whenever debt becomes heavy, interest rates are adjusted. Whenever confidence begins to slip, policymakers reassure the public that everything remains under control. But systems built on confidence have a weakness. They only work as long as people believe they will continue to work. The modern financial world runs on a delicate balance of trust. Every currency in circulation today represents a promise, a belief that the numbers printed on paper or displayed in digital accounts will retain their purchasing power tomorrow. That belief is the foundation upon which savings, pensions, investments, and entire economies are built. Once that belief begins to weaken, even slightly, the consequences ripple outward in ways that few people fully appreciate until it is too late. In recent years, the signs of strain have become increasingly difficult to ignore. Debt levels across governments, corporations, and households have reached heights never before seen in modern history. Trillions upon trillions have been borrowed under the assumption that cheap money would remain available indefinitely. For a time, it seemed like a brilliant strategy. Low interest rates encouraged spending, markets surged upward, and financial assets climbed to levels that once seemed unimaginable. But debt has a hidden cost. It amplifies both growth and fragility. When borrowing fuels expansion, everything appears strong. Businesses invest aggressively, governments increase spending, and households take on mortgages, loans, and credit lines with confidence that future growth will make repayment manageable. Yet the very structure that allows this expansion also creates vulnerability. When interest rates rise, when economic growth slows, or when unexpected shocks occur, the burden of that debt becomes far heavier than anyone anticipated. Suddenly, the same system that once accelerated prosperity begins to magnify instability. This is where the current environment becomes particularly dangerous. The global financial architecture is more interconnected than ever before. Capital flows instantly across borders, markets react within milliseconds, and economic events in one country can cascade through the rest of the world with breathtaking speed. A policy change in one major economy can alter exchange rates everywhere. A banking problem in one region can trigger volatility across multiple continents. These interconnections create efficiency during stable times, but they also create a chain reaction during periods of stress. Imagine a row of dominoes stretching across the entire global economy. When the first piece falls, the motion continues, whether anyone wants it to or not. This is the reality of modern finance. The complexity of the system makes it appear strong, yet that same complexity hides structural weaknesses that only reveal themselves during moments of pressure. One of the most significant pressures facing the world today is the gradual erosion of currency purchasing power. Inflation is often discussed in technical terms, presented as percentages and charts that fluctuate from month to month. But behind those numbers lies a much deeper story about how money itself is created and managed. In order to stimulate economic activity during times of crisis, financial authorities have repeatedly expanded the supply of money within the system. Liquidity programs, emergency measures, and unconventional policies have injected enormous amounts of capital into global markets. These actions were designed to stabilize economies and prevent deeper recessions, and in many cases they succeeded in the short term. However, increasing the supply of money without a proportional increase in real economic productivity inevitably leads to a problem. The value of each unit of currency slowly diminishes. Prices begin to rise. Purchasing power declines. The change may appear gradual at first, almost invisible to those not paying attention, but over time it becomes impossible to ignore. What once bought a full basket of goods now buys only a portion of it. Savings accounts that once preserved wealth now struggle to keep pace with rising costs. The quiet tax of inflation begins to eat away at financial security. For individuals and institutions alike, this creates a dilemma. Holding large amounts of cash becomes less attractive because its value steadily erodes. Traditional safe investments such as government bonds may fail to compensate for inflation, especially when interest rates remain artificially low relative to rising prices. Even equities, which historically offered protection through corporate growth, can struggle when economic uncertainty intensifies and operating costs surge. The result is a growing search for assets capable of preserving purchasing power in an environment where traditional financial instruments appear increasingly fragile. History offers valuable lessons about how societies respond to these conditions. Whenever confidence in paper currency begins to weaken, people instinctively look for alternatives that cannot be created at will by policy decisions or monetary expansion. They look for assets that possess intrinsic value, assets that exist independently of political promises or financial engineering. Throughout centuries of economic upheaval, tangible assets have repeatedly served this role. They represent real value in a world where financial abstractions can vanish with the stroke of a keyboard or the collapse of a financial institution. This instinct is deeply rooted in human psychology. When uncertainty rises, people gravitate toward things they can see, touch, and store. Tangible assets provide a sense of permanence that digital numbers and paper contracts cannot match. They exist outside the network of obligations that tie modern financial systems together. And when the stability of that network begins to wobble, the demand for tangible stores of value can surge dramatically. Another factor intensifying current market tensions is the growing disconnect between financial asset prices and underlying economic fundamentals. For years, markets have benefited from abundant liquidity and aggressive stimulus policies. This environment pushed stock markets, real estate values, and speculative assets to record levels. While rising asset prices often signal prosperity, they can also mask deeper imbalances. When valuations climb faster than productivity or earnings growth, markets become increasingly dependent on continued stimulus to maintain their upward trajectory. Remove or reduce that stimulus, and the foundations supporting those valuations begin to weaken. This creates the possibility of sudden corrections that catch investors off guard. When sentiment shifts, liquidity dries up, or economic data disappoints expectations, markets that once seemed unstoppable can reverse direction with startling speed. Volatility is not merely a possibility in such environments. It becomes an inevitability. Adding another layer of complexity is the role of technology in modern financial markets. High-frequency trading systems, algorithmic strategies, and automated execution platforms now dominate large portions of market activity. These systems are designed to react to information within fractions of a second, analyzing data and executing trades faster than any human could possibly respond. While these technologies increase efficiency during normal conditions, they can also amplify volatility during times of uncertainty. A sudden headline, policy announcement, or unexpected economic data release can trigger cascades of automated trades across multiple markets simultaneously. Price movements that once unfolded over hours or days can now occur in seconds. This rapid reaction speed means that investors who are not closely monitoring structural shifts may find themselves caught off guard by market movements that appear to come out of nowhere. In reality, those movements are often the culmination of pressures that have been building beneath the surface for months or even years. Geopolitical tensions further complicate the picture. Trade disputes, sanctions, political instability, and regional conflicts all have the potential to disrupt supply chains, alter capital flows, and reshape investor sentiment. In a world where economies are deeply interconnected, the effects of these disruptions rarely remain confined to a single region. They ripple outward through currency markets, commodity prices, and investment portfolios around the world. The convergence of these forces, monetary expansion, rising debt burdens, inflation pressures, asset valuation risks, technological acceleration, and geopolitical uncertainty, creates a financial environment unlike anything most investors have experienced before. This is not merely a period of routine market fluctuation. It is a period of structural transition. And during times of transition, the assets that protect wealth often differ from the assets that generate it during stable conditions. One of the most intriguing aspects of the current environment is the renewed attention being paid to commodities and tangible resources. Unlike financial instruments, commodities represent physical materials that underpin the real economy. They cannot be printed, digitally created, or expanded at the same pace as monetary supply. Their availability depends on geology, infrastructure, labor, and time. Among these resources, one in particular occupies a unique position within both the industrial economy and the financial system. It is used extensively in manufacturing, technology, medicine, and energy infrastructure, yet it also carries centuries of history as a trusted store of value. This dual nature creates dynamics that few other assets share. On one side, industrial demand ties its value to the growth of emerging technologies and global manufacturing. On the other side, monetary demand ties its value to investor sentiment, currency stability, and macroeconomic conditions. When these two forces begin moving in the same direction, the effects can be profound. In recent years, industrial applications have expanded rapidly. Advancements in renewable energy systems, electronics, advanced communications infrastructure, and medical technologies all require specialized materials with unique conductive and chemical properties. Many of these technologies rely on components that cannot easily be substituted with alternative materials. As these industries grow, their demand for certain resources increases accordingly. At the same time, mining production for many of these materials faces constraints. Extracting resources from the earth requires exploration, capital investment, environmental approvals, and complex supply chains. New mining operations can take years to develop, meaning supply cannot quickly respond to sudden increases in demand. This imbalance between expanding demand and relatively inflexible supply creates the conditions for significant price volatility. In many cases, the earliest signs of these imbalances appear not in mainstream headlines, but in specialized market indicators. Industrial consumption trends, supply chain disruptions, and shifts in investor positioning can all provide early signals that a commodity market is tightening. Those who monitor these signals carefully may recognize changes long before they become obvious to the broader public. For investors and individuals concerned about preserving wealth during uncertain times, understanding these structural forces is essential. Financial markets often move in cycles, driven by confidence, policy decisions, and economic conditions. Assets that underperform during one phase can become critical during another. Recognizing when those transitions are beginning is one of the most valuable skills in financial decision-making. The current landscape suggests that such a transition may already be underway. Currency volatility, inflation concerns, debt pressures, and geopolitical tensions are converging in ways that challenge long-standing assumptions about financial stability. As these pressures intensify, attention naturally shifts toward assets capable of functioning both as industrial necessities and as stores of value. The implications of this shift extend far beyond short-term price movements. They touch the core question of how wealth is preserved in a world where traditional financial structures appear increasingly strained. For those paying close attention, the signals are becoming clearer with each passing month. Markets are communicating something important about the direction of global finance and the role that tangible assets may play in the years ahead. Ignoring those signals could prove costly, because when systems built on confidence begin to tremble, the assets that endure are rarely the ones most people expect, and the stage may already be set for one of the most consequential revaluations the commodity markets have seen in decades. The deeper you look into the current financial landscape, the more you begin to see how fragile the system really is. Beneath the surface of everyday market activity, there is a growing tension between what the financial system promises and what the real economy can actually sustain. That tension is beginning to show itself through subtle signals that many people overlook, but to those who are paying attention, those signals are becoming louder with each passing month. One of the clearest signs appears in the relationship between supply and demand for physical resources. Unlike digital money or financial instruments, physical materials cannot be created instantly to satisfy rising demand. They must be discovered, extracted, processed, and transported through complex supply chains that span continents. Each step takes time, investment, and stability within the global system. When any part of that chain becomes strained, the entire balance begins to shift. Right now, that balance is shifting. Production in many resource industries has struggled to keep pace with the rapidly expanding needs of modern technology and infrastructure. As economies push toward advanced electronics, renewable energy systems, and high-performance communications networks, the demand for specialized materials is rising faster than many expected. These technologies are not optional luxuries. They are becoming foundational to the next phase of global development. Yet production growth has not matched that acceleration. Mining operations require years of planning and development before new output reaches the market. Environmental regulations, logistical challenges, and rising operational costs make rapid expansion extremely difficult. Even when companies attempt to increase output, the process moves slowly compared to the speed of global demand. This creates a structural imbalance that slowly tightens the market. At the same time, investment behavior begins to shift when financial uncertainty rises. When people grow concerned about inflation, currency stability, or the long-term reliability of financial institutions, they begin searching for assets that exist outside traditional systems. The instinct to hold tangible stores of value becomes stronger whenever economic confidence weakens. When investment demand meets industrial demand in the same market, something interesting happens. Two powerful forces begin pulling in the same direction. On one side, industries require the material to build technology, infrastructure, and energy systems. On the other side, investors seek the same material as a store of value and protection against financial instability. When both groups compete for the same limited supply, the available inventory begins to disappear faster than it can be replaced. Markets rarely react slowly when this occurs. Instead, they often move in sudden bursts of volatility as buyers rush to secure supply before prices rise further. What appears calm one moment can quickly transform into aggressive accumulation as participants realize the imbalance is growing. Another important factor is the difference between paper markets and physical markets. In financial exchanges, contracts representing future delivery of commodities can be traded in enormous volumes. These paper instruments allow investors to speculate on price movements without actually taking possession of the underlying material. But physical markets operate under very different constraints. Actual bars, coins, and industrial supply must exist in the real world. They cannot be multiplied with a keystroke. When physical demand begins to rise sharply, inventories can tighten quickly, and the difference between paper prices and real-world availability becomes more noticeable. Premiums start rising, delivery times begin to stretch, dealers report shortages in certain forms of supply. These signals are often early indicators that a market is entering a new phase. What makes the current moment particularly important is the combination of factors converging at once. Industrial consumption is expanding as new technologies scale globally. Investors are becoming increasingly aware of monetary instability and searching for protection. Supply growth remains constrained by structural limitations in mining and refining capacity. These forces rarely align perfectly, but when they do, markets can experience dramatic revaluations. History shows that commodities tied both to industry and monetary demand often move in powerful cycles. Long periods of quiet accumulation can suddenly give way to rapid price expansions as supply shortages become undeniable. Once momentum begins, the movement tends to attract even more attention, drawing additional capital into the market. This feedback loop accelerates the shift. Early participants secure positions quietly while conditions still appear normal. Later participants arrive after headlines begin describing shortages and price surges. By that stage, the market has already moved significantly. That pattern has repeated itself throughout financial history. The key difference between those who benefit from these cycles and those who miss them often comes down to awareness. Understanding the structural forces shaping supply, demand, and monetary policy allows individuals to recognize turning points before they become obvious. And right now, many of those signals are beginning to align. Rising inflation concerns, growing debt burdens, shifts in investor behavior, expanding industrial demand, tightening physical supply, increasing volatility across global markets. Individually, each factor might appear manageable. Together, they form a pattern that suggests the financial landscape may be approaching a significant transition. Periods like this rarely remain quiet for long. Markets tend to adjust suddenly once enough participants recognize the imbalance. Prices revalue, capital flows shift, and assets that once seemed ordinary suddenly take on new strategic importance. For those watching carefully, the message is becoming difficult to ignore. The environment is changing, and the assets capable of preserving wealth during turbulent periods are beginning to attract renewed attention. The reality is that major financial shifts rarely announce themselves with perfect clarity. They begin quietly, building momentum beneath the surface, while most people continue assuming the system will behave the way it always has. But history shows that when monetary pressure, rising demand for tangible assets, and tightening supply converge, markets can change direction faster than anyone expects. This moment may be one of those turning points. The signals are already appearing for those willing to look closely. The question is not whether the global financial system will continue evolving. It always does. The real question is whether people recognize the shift early enough to position themselves before the rest of the world catches on. Because when the next major move finally arrives, it rarely waits for anyone who hesitates.